Hi there, welcome to Nepi Invest. Today we start the countdown, looking at the 30 best performed companies on the ASX since 2013. In this particular video, we're counting down starting at number 30 and finishing at number 26. But before we start the countdown, there are a few things I want to go through first, including some important points. We'll also have a look at some of the worst performing companies on the ASX as well. So here are some important points, and I want to make this clear that this top 30 companies on the ASX since 2013 is not my opinion. This is just based off numbers. In fact, it's based off the total analyzed return over the past 10 years. So this is simple enough. I didn't have to go through every single company and come up with my own list. So this is an objective list, not a subjective list. And I use Guru Focus, and I actually am a Guru Focus subscriber. Now, when I do use a site like Guru Focus, or maybe you might use QuickFS or Ticker, just be aware that sometimes the numbers can be a little bit inaccurate. So sometimes I will go through the numbers that Guru Focus does provide, but largely they are accurate enough for this type of video. And the other very important point is I'm only using companies, well, probably the best way to put it is the only companies in this list are those that have been listed since 2013. So you won't find companies like WiseTech in this list because they listed on the ASX after 2013. So if I did another video in terms of the best performing companies over the past 5 years, you'll probably find that WiseTech is high on that list. And now on to the most important point. Past performance is not a predictor for future success. So even though these 30 companies have performed really well in the past 10 years, doesn't mean they're going to perform really well in the next 10 years, 20 or 30 years. And I am going to show you an example which really illustrates that just because a company might perform or might not even perform over a 10-year period doesn't mean it can't do the complete opposite in the next 10 years. And I'm going to use an example of a very famous and one of the biggest companies in the world. The other thing I should mention, this list only includes those companies that had a market cap above $1 billion as of the 31st of May 2023. So there are some companies with a market cap below $1 billion that have had stellar performances over the past 10 years, but they are much rarer because if a company has performed really well over the past 10 years, more than likely their market cap is going to be above $1 billion. So this is the chart of that said company between 2003 and 2013. So if you looked at this chart of this particular company, you might say, well, this is not a good quality company. Share price has done absolutely nothing over a 10-year period. Now, I won't tell you what this company is, but let me ask you a question. Would you buy this company in 2013 if you saw this particular chart? And here is the updated chart for that said company, which is Microsoft. So this is from 2013 to 2023. And this is definitely the sort of chart you want to be a shareholder of because share price of Microsoft has increased from about $20, $30 all the way up to a current share price of $340 odd dollars. So this has been a 10 bagger over the past 10 years. So you might be saying, why did this company not perform between 2003 and 13, but has really performed well during this 10-year period? And the reason behind that is simply because during 2003 and 2013, Microsoft was growing. I had a look. Their earnings per share, I think it was revenue per share, actually tripled during that 10-year period. But also during that 10-year period, it's very important that the multiple or the P ratio of this company fell. So Microsoft went through a period of multiple contraction. So that 10-year period, they went through a period of financial expansion, but also multiple contraction. And both of those things canceled each other out. So the share price went sideways. Now, during this particular period between 2013 and 2023, they've continued to expand financially, but we've also seen some multiple expansion as well. That's how you get a 10 bagger for a company like Microsoft. Probably also should mention, not only has this company expanded financially, they've started to accelerate the financial expansion as well. And that's very important to note that even though a share price of a company might go sideways over a 10-year period, doesn't mean that's not a high quality company. I would always regard Microsoft, even back in 2013, as a high quality company. So that's actually another thing I'm going to be looking for in the future. Those high quality companies that haven't performed in terms of share price action over a certain period of time, but they continue to grow, particularly when it comes to revenue and earnings per share. As I've already mentioned, one of the things I am looking for is any unloved company on the ASX or even on international exchanges that are growing at a pretty good clip, but are just not performing. Share price is going sideways or even down, even though the company might be growing at a pretty good clip and the company is going through a period of multiple contraction. So I am also going through the worst performing companies on the ASX. I've already gone through the 10 worst, and these are the next 5 worst performing companies. So these will be ranked between 11 and 15. And there are some big names here, including QBE, Worley, Cromwell Property, Bank of Queensland, and AGL Energy. So what I'm looking for in these 5 companies is good revenue growth, earnings per share growth, nice dividend growth, and return on invested capital above 10. So if I see that in these worst performing companies, that's a sign the market is missing the story, missing the fundamental growth of the company, and there is potential that company might be undervalued. But we don't get that with either of or any of these 5 companies. In fact, if you look at the 10-year revenue per share growth, it's negative for all these companies apart from AGL Energy, which is only at 2.3%. In fact, Worley has seen negative 6.7% revenue growth. Earnings per share growth, typically negative, positive for a couple of companies. Dividend growth typically is negative apart from AGL Energy. And if you look at the return on invested capital, less than 10, in fact, almost less than 5, definitely less than 6 for all 5 of these companies. And that is telling me that these companies aren't going to grow that quickly over the next 10 years because you really want a high return invested capital for that continued growth over a longer period of time. And now onto the list. And coming in at number 30 is James Hardie. Now, this could have been a surprise if I did this video a few months ago, before I did a standalone video on James Hardie, a Nepi's analysis video. And I was surprised that James Hardie could be considered a high quality company on the ASX, particularly if you look at the performance of this company over the past 10 years. So James Hardie has a market cap of over 10 or $11 billion, and that market cap is in US dollars because for some reason Guru Focus puts the market cap in US dollars. Revenue growth of 14.6% per year. So that is one thing I'm looking for. I want revenue growth above 10% per year, but I can take between 5 and 10%, particularly if a company does have a pretty good dividend. Earnings per share growth of 21.4%, which is quite nice. Probably the only slight red flag is the dividend growth is quite low at only 2.5%. Nice gross margin, return on invested capital high at 15.6. That's definitely the sort of range I am looking for. Anything above 10 for return on invested capital is quite good. And an analyzed total return of 17.3. So definitely over the past 10 years, James Hardie can be considered a high quality company based off these numbers. But then I went back further in time. I went through the period between 2003 and 2013. Because even though I was a little bit surprised that you could consider this company to be high quality, when I first started investing way back, well over 10 years ago, I actually did a little bit of research on this company. And the main reason was because James Hardie was a sponsor of Parramatta Eels about 40 years ago, maybe even less than that. So I just wanted to do a bit of research on this company. And back in, would have been about 2010, I probably wouldn't have considered this company to be high quality. Very little revenue growth, very little earnings per share growth, and even that chart, the share price chart, the shares are just going sideways. Share price just going sideways. So things can change when it comes to a company's performance over time. So this is a perfect example, or James Hardie is a perfect example of a company that has transitioned from a low quality to arguably a high quality company over the past 10 years. And this is James Hardie's chart, weekly chart over the past 10 years. And this is the sort of chart we're going to see over and over again. And there are going to be subtle differences between the charts we see. But typically, and maybe not typically, but for all these companies, you'll see the share price go from the bottom left to the top right. Now, some of these companies, you'll see the majority of the share price performance was between 2013 and 2018. And then some of these companies, we saw pretty good performance between 2018 and 2023. That's probably true, or maybe true for James Hardie. But you'll notice the share price doesn't go up in a straight line. There are periods of time when James Hardie was absolutely loved by the market, particularly between 2020 and 2022. We saw the share price rise from $16 to $58 in a fairly short period of time. Between 2013 and about 2018, share price was just gradually going higher. And we have seen a lot of weakness in James Hardie over the past 2 years. So even though this company has given really good returns of 17.6% per year, the share price is still well below the all-time highs. Another thing you might notice for companies like this is when the share price gets below, say, any sort of moving average you use, and one of the moving averages I will use for these companies is the 150-week moving average. And where the share price for James Hardie gets below that, that could be an argument to think about taking a position in a company. So it's only gone below that line, that moving average, which is the solid blue line here, a few times in the past. And it only stays below that blue line for a short period of time, at most for about 1 year. Did that in 2018 and 19, and it's right now below that moving average as well. But we have seen a bit of a breakout in the share price if you look at the daily chart. Now, for most of the companies in this particular list, we're only going to be looking at the one chart, the weekly chart between 2013 and 2023. But James Hardie, as I've mentioned, when I first looked at this company well over 10 years ago, I don't think I could have considered that a high quality company because very little growth in the company itself. And that was portrayed by the chart. So let's have a look at the James Hardie chart between 2003 and 2013. Now, when I did research on James Hardie well over 10 years ago, it would have been about 2010 or 11, I probably looked at the fundamentals of the company. I might have looked at the chart, and the chart looked pretty ugly, to be honest with you. So nothing to really like when we look at the 2003 to 2013 chart for James Hardie. And unlike Microsoft, which was growing between this period, James Hardie wasn't doing that. But the breakout in share price for James Hardie actually occurred in 2012. That was the start of the uptrend. You actually see it on the weekly chart quite well. So sometimes, even for these low quality companies, just have a look at the chart. If the market is thinking that the company might be undergoing a good growth spurt, you might see the share price move up into an uptrend, just like what James Hardie did. And then if you did buy James Hardie shares back in 2012 or 13, you might have held them for about 5 to 10 years, taking advantage of the share price increasing from about $7 all the way up to a high of over $50. Coming in at 29, and this might be a surprise to some people, particularly because of what's happened with this company over the past, say, year or so, share price has decreased significantly, and that company is Domino's Pizza. Revenue growth of 25% per year, earnings per share growth of 19.7, dividend growth, really nice dividend growth of 22.7, return on invested capital coming in just over 10, 11.9. So that is acceptable. I am looking for return on invested capital above 10 and an analyzed total return of 17.4. Now, more than likely, if I did this video about 2 years ago, Domino's Pizzas might come near the top of the list. So the share price has fallen a lot over the past 2 years. Shareholders have still gotten a 17.4% analyzed return over the past 10 years. One of the major features of Domino's Pizza is that this company can be a hyped up stock on the ASX, sort of like a cult stock, and at times it can be an unloved stock on the ASX. And we have seen 4 distinct periods over the past 10 years. The first period was between 2013 and 2016, towards the middle of 2016, when the share price rallied from about $10 all the way up to a high of $75. And I still remember this company being really hyped up. And then that hype fell away for about, we'll say 4 years. So share price actually fell between 2016 and 2020. And then there was another hyped up period between 2020 and 2022 when the share price went from about $45 to a high of almost $170. And right now, we're in a period of time when this company is completely unloved by the market, which is understandable because their most recent results were very disappointing. But I think there is possible value in this company right now if they can achieve and continue to achieve the growth they have seen in the past 10 years. If they can't get that sort of growth, if this company is now mature and there's very little growth moving forward, I probably would not call Domino's Pizzas good value right now. Now on to number 28, and this is Goodman Group. Some people might refer to this as a REIT. I don't. They're way more than just a REIT. In fact, I'd call them an asset manager because they do own, or not own, they manage a lot of properties all around the world, which REITs don't really do. And I wouldn't call Goodman Group a cult stock, but this is, if people do rank their most favored REITs, this would come in at probably number one. But again, I wouldn't consider Goodman Group as a REIT. Revenue growth, about 8%. Earnings per share growth, 22.6. Dividend growth, nice, 5.8%. Particularly for this sort of company, that's pretty nice. And return on invested capital, I'm not sure you can use that for this type of company at 3.2, but the analyzed total return coming in at 17.6% per year. And you'll definitely take that sort of return for a company that you might consider a REIT. And the chart for Goodman Group looks absolutely beautiful. Again, from the bottom left to top right, exactly what you want to see. But there has been weakness in this company since about late 2021, which is understandable because without doubt, a rising interest rate environment would potentially not be beneficial for this company, detrimental for this company, if you will. So that's why share price has fallen from $27 to a current share price of around 20 or just below 20. But again, whenever the share price gets below the 150-week moving average, and it's only done it twice. The first time was during the COVID-19 financial panic, and the second time is right now. But the share price has been rallying from the low, which we did see in September, October last year. Share price did get below $16 for a very brief period of time. So definitely, this would be probably a high-quality company on the ASX. It's definitely trending towards being a cult stock among fund managers that absolutely love this company. And that's why if you do actually calculate the valuation of this company, which is quite hard, in my opinion, you might think it is overvalued. So definitely a high quality company on the ASX that has given a good return over the past 10 years. A nice diverse group of companies in this first list. So we've gone from a building company, building supply, whatever you want to call James Hardie, to a retail company, discretionary retail. Would you call pizza discretionary retail? I would think, particularly if they're selling pizzas really cheaply, that they would do really well in this sort of environment. And then we had a look at a REIT, even though I wouldn't call them a REIT. And now we're on to an infrastructure company, Atlas Arteria. Used to be called Macquarie Roads up until about 3 or 4 years ago. So I always know this company as Atlas Arteria. They have toll roads all around the world, particularly the two I do know, Chicago Skyway and Dulles, something in Dulles as well. So this company has performed really well over the past 10 years. Now, I went back to 2013 because Guru Focus didn't give me any revenue growth or earnings per share growth. And when I had a look at some of their financial statements from 2013, they had no revenue for some reason. I'm not sure what happened to this company back in 2013. But dividend growth at 22.8%. Again, I wouldn't look at return on invested capital for this type of company, but analyze total returns of 17.7% per year. So definitely, if you want to get into the infrastructure space, don't ignore Atlas Arteria. Although in saying that, if you look at the 10-year chart, you'll notice this company has gone through two distinct periods. A really good growth phase between 2013 and just before the COVID-19 financial panic. In fact, the share price of Atlas Arteria went from about $1.40 to $7.90. But since then, in fact, the share price high for this company was just before the COVID-19 at that level, $7.80 or 90 cents. And the share price has not got above that level. It tried to in the middle of 2022. In fact, that's a fairly strong resistance level at about $7.80. But share price doing really not much now. So share price over the past 3 or 4 years has gone absolutely sideways. So right now, that's the second phase for this company. But the returns for Atlas Arteria between 2013 and 2020 would have been significantly higher than 17.7%. Coming in at number 26 is Corporate Travel Management. Not sure there's going to be any other travel stocks in this list. In fact, Flight Centre was one of the worst performing companies on the ASX, coming in at something like number 2 or 3. So definitely a big difference between some of the travel stocks and Corporate Travel Management. Revenue growth, 19.2% per year. You'll notice that earnings per share growth is negative. That's because this company was hurt negatively by COVID-19, but this company is moving back into a significant growth phase. Dividend growth, NA, because I don't think they had a dividend recently in the last year. Gross margins, really nice high gross margins, 96.4%. Return on invested capital sitting really nicely at 14.6%, and an analyzed total return of 18.1% per year. But when we look at the chart, you'll notice, just like Atlas Arteria, this company has gone through two distinct phases over the past 10 years. In fact, you could divide the last 10 years for corporate travel management into two 5-year blocks. So when I do look at the best performing companies on the ASX over the past 5 years, corporate travel management won't be on that list. And it won't be on that list because of this particular chart. So let's have a look at the weekly chart for this company. So corporate travel management, I still remember this company back in 2012 or 13, and it was fairly small at that point in time, but it was growing really nicely. And I just wish I took a position in the company back then, because the share price went from about $3 or just around about $4, we'll say, no, just above $3, all the way to a high of $33 in about 5 to 6 years. Yes, this was a 10-bagger over a 5 to 6 year period. And then the share price did reach its high in the middle of 2018, and the share price of this company hasn't got back up to those levels. But I do think there is potential over the next 5 years. It will get back up and past beyond $33. So you notice the share price of this company has really been a laggard over the past 5 years. So again, probably, I won't say negative returns for this company over that past 5 years, because this company has had a little bit of dividends, but you wouldn't see 18% analyzed returns over the period between 2018 and 23. So the majority of the returns for this company was in the first 5 years of this decade period. So I think it's always important to have a look at the chart. And this could be another Microsoft story, where the share price did nothing over a 5-10 year period. Then all of a sudden, the share price breaks out and you see another really good 10-year period. So that's potentially what's going to happen with this company over the next 5 to 10 years. I don't know. No one knows, in fact. That's all I have for this list of companies, the 30 best companies on the ASX, looking at those companies that came in between 30 and 26. The next video will be looking at those companies that came in between 25 and 21. If you have any questions about this list or any companies I've mentioned in today's video, I'd love to hear your thoughts, your questions, so leave them in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.